Welcome. Today we're diving into one of the most fundamental concepts in Forex trading, the spread. If you've ever looked at a Forex quote, you'll notice two prices for every currency pair, the bid and the ask. The difference between these two prices is called the spread. Understanding the spread is crucial because it directly affects your trading costs and potential profits. Throughout this video, we'll break down what a spread is, why it exists, how it's measured, and the different types you'll encounter. Let's start by looking at what the bid and ask prices really mean. Every Forex quote, you'll see two prices, the bid and the ask. The bid price is the rate at which you can sell the base currency, while the ask price is the rate at which you can buy it. For example, if EUR/USD is quoted as 1.1051111053, you can sell euros at 1.1051 and buy them at 1.1053. The broker always quotes a slightly higher price for buying and a lower price for selling. This small difference is not random, it's the broker's way of making money, especially when they advertise no commission trading. But why does the spread exist? The spread is essentially the fee for immediate transactions. Instead of charging a separate commission, brokers build their profit into the spread. When you buy, you pay a bit more than the broker did. When you sell, you receive a bit less. This difference ensures the broker earns money for providing liquidity and instant trade execution. It's a business model that makes sense. Brokers need to cover their costs and make a profit, just like any other service provider. Think of the spread like selling your old iPhone to a store. The store needs to buy your phone at a lower price than it plans to sell it for so it can make a profit. If the store can sell the iPhone for $1,000, it might only offer you $999. That $1 difference is the spread. In Forex, the broker buys from you at a lower price and sells to you at a higher price, pocketing the difference. This simple analogy helps clarify how spreads work in everyday terms. Spreads in Forex are usually measured in pips, which represent the smallest unit of price movement for a currency pair. For most pairs, 1 pip equals 0.0001. For example, if EUR/USD is quoted at 1.1051111053, the spread is 2 pips. For pairs involving the Japanese yen, 1 pip is 0.01, so a quote like 110.111004 means a spread of 4 pips. Understanding how to read and calculate spreads in pips is essential for managing your trading costs. There are two main types of spreads you'll encounter in Forex trading, fixed and variable, also called floating. The type you see depends on your broker's business model. Fixed spreads remain constant regardless of market conditions, while variable spreads fluctuate based on supply, demand, and market volatility. Knowing the difference can help you choose the right broker and trading strategy for your needs. Spreads stay the same no matter what's happening in the market. Whether the market is calm or highly volatile, the spread doesn't change. Fixed spreads are typically offered by brokers who operate as market makers or use a dealing desk model. These brokers buy large positions from liquidity providers and then offer smaller positions to traders, acting as the counterparty to your trades. Because they control the prices, they can keep spreads fixed. Trading with fixed spreads has its perks. First, it usually requires less capital, making it accessible for traders with smaller accounts. Second, it makes transaction costs predictable. Since the spread never changes, you always know what you'll pay when you open a trade. This predictability can be especially helpful for beginners or those who want to keep their trading costs under control. However, fixed spreads aren't perfect. Since pricing comes from just one source, your broker requotes can happen often, especially during volatile markets. A requote means the price has changed before your trade is executed and you'll be asked to accept a new, often worse price. Slippage is another issue. In fast-moving markets, the price you get may be very different from what you expected. This can be frustrating, especially if you rely on precise entry. Variable spreads, as the name suggests, are always changing. They're offered by non-dealing desk brokers who get prices from multiple liquidity providers. The spread widens or tightens based on market supply, demand, and volatility. During major news events or low liquidity periods, spreads can widen dramatically. This model offers more transparent pricing, but also means your transaction costs can fluctuate unexpectedly. One big advantage of variable spreads is that you won't experience requotes. Since prices adjust in real time, you get the current market price even if it's changing quickly. Variable spreads also mean more transparent pricing, as competition among liquidity providers can lead to better rates. However, keep in mind that slippage can still occur, especially during periods of high volatility. Variable spreads aren't ideal for every trader. Scalpers and news traders who rely on tight spreads and quick trades may find that sudden spread widening can quickly eat into profits or even turn a winning trade into a loss. The unpredictability of variable spreads means you need to be cautious, especially during major news releases or low liquidity periods. But which is better, fixed or variable spreads? It really depends on your trading style and needs. If you have a smaller account and trade less frequently, fixed spreads might be more cost-effective and predictable. If you're an active trader with a larger account and want fast execution without requotes, variable spreads could be a better fit. Always consider your risk tolerance and trading habits before choosing a broker. Now let's talk about how to calculate the actual cost of the spread. All you need to know is the value per pip and the number of lots you're trading. For example, if the spread is 1.4 pips and you're trading a mini lot 10,000 units with each pip worth $1, your transaction cost is $1.40. If you trade more lots, simply multiply the pip value by the number of lots. The larger your position, the higher your total transaction cost, since the spread applies to every lot you trade. Let's look at another example. If you're trading 5 mini lots and the spread is 1.4 pips, your transaction cost is $7. The calculation is simple. $1 per pip times 1.4 pips times 5 lots equals $7. This linear relationship means that as your position size increases, so does your total cost. Always factor in the spread when planning your trades, as it can have a significant impact on your overall profitability. Wrap up: understanding the spread is essential for every Forex trader. It's the hidden cost built into every trade, affecting your bottom line whether you notice it or not. By knowing how spreads work, how they're measured, and the difference between fixed and variable spreads, you can make smarter trading decisions. Always consider the spread when choosing a broker and planning your trades. Thanks for watching and happy trading.